Thanks for joining me. My name is Mike Gendron. I'm a partner with CFO Insight, and today we're going to talk about reporting. You'll recall in our last session we discussed strategic planning and the need for measurable goals. Well, a follow-on to that, a natural follow-on to that, is reporting. What is reporting? What is reporting? Here's an example financial statement, and you might find this in a typical middle market company. It's accurate, provides 2 years for comparison. It has the basics: sales, cost of sales, SG&A broken down into 4 or 5 categories. But what's wrong with this? What's wrong with this as a management report? Well, it doesn't tell you what's going on in the business. So today we're going to peel this apart. We're going to peel it apart. The first thing we're going to talk about is, what is reporting? Well, first of all, reporting is timely information. Getting a daily report that takes 3 or 4 days to prepare is a waste of time. So it is timely information. It is accurate information, and best of all, it is consistently prepared. Consistently prepared. Now, when we talk about reporting, we look at, in this case, sales as an example. What does that tell us? That's a historical perspective. It says total sales are XDX million dollars. Well, as a manager, what do I do with that information? What do I do with it? I will have to pursue and go through conversations with many people to find out what's going on. Well, my interest as a manager might be to understand what the product line sales are, or what the geographic sales are, or what happened in new product introductions. Are we meeting our goals and objectives as we've defined in our strategic plan? Well, that's not in this total number. So I have a definite desire, a need for more information. So this report doesn't answer what I need as a CEO to run the business. Not only that, if I look at this report and talk to the VP of sales saying, how are your territories doing? He doesn't know, because this is the report. So what do we measure? I mean, I've talked about products and territories and perhaps new countries and who knows what else. Joint venture sales. You know, there are all kinds of things to talk about. Well, we want to measure what counts, and what counts varies by year because we may have different strategic priorities. We may have different strategic priorities. In any well-managed company, everyone in the organization has goals and objectives. Strategic goals roll down to activity goals in every functional area at every level. So it's not just dollars and cents. There might be other metrics that are important. For example, in human resources, a very important metric might be average time to hire a replacement. Average time to hire a replacement. In R&D, it might be managing a project, a timeline and deliverables so that we meet a strategic objective of new product introductions. Everybody has performance objectives in a well-managed company. In manufacturing, it might be first-time quality approval, first-time quality process accepted. It might be standard cost for sure. It might be timing to get orders through to customers. Total, complete orders might be an important measure. That's not a dollar amount. That's not a dollar amount. Effective reporting has layers. Matches the responsibility level of the individual. So, for example, total sales may be important to the CEO. Regional sales, product line sales might be important to product managers or regional directors. Everybody has a reporting responsibility. Now, in some cases, you may want group goals because that is the organization, that's the element in your organization that is responsible for it. So they may work together as a team. How often should you report? Well, you want to match your reporting cycle to your business cycle. I may have mentioned earlier, you don't want to spend 3 days preparing a 1-day report because it's out of date. It's of no value. I've worked in companies, walked into companies, where they do daily reports that take 2 or 3 days to develop. Weekly reports take 2 weeks to develop. Well, there's no purpose in that. What we've done in those cases is scale the report down so we can provide timely, accurate information to the management that needs it. It's not as complete as we liked, but we made progress. So reporting is something that's kind of an iterative process that allows the individuals to improve their performance. What should you measure? What should you measure? What's important this year? Your strategic priorities should drive your reporting. In some cases, it will be sales, it might be product line sales, it might be geographic sales, but in other cases, it might be new product introductions and rollout and how well you're doing. It might be timing on opening up a country or a joint venture relationship. How well is that doing? In cost of sales, it might be installing new equipment or bringing a new plant online. Everybody has objectives. You want to measure success as well as failures. That sounds strange, doesn't it? But a failure is really an opportunity to improve. In most manufacturing organizations, I like to look at scrap and rework, because that's an opportunity to improve performance and improve profitability. We want to measure activities, not just dollars. I mentioned earlier, time to hire. Not bad. First-time quality acceptance, not bad. Those are not dollar amounts, yet they will drive profitability in your organization. We want to look at long-range issues and try and understand how incremental reporting, timely reporting, improves the management of the business. And who do we send the reports to? To whomever can influence the outcome of the activities. So we're talking about timely, accurate information prepared on a consistent basis, going to the level in the organization, whether it be the CEO, the VP, the director, the manager, the supervisor, or the individual performer. And we want to measure the timing of that. So an individual performer may get a daily report of the throughput of a cost cell. The CEO may get a daily total sales report, so he can monitor how well or poorly the business is going. But everybody has reports, and you deliver them on a time scale where the people can actually react. So today we talked reporting, blends right into the strategic planning process. Next time we're going to talk about people. Thanks for joining me.